The story of the first women bankers isn't just a footnote in economic history. It's a fascinating window into how gender, money, and power have intersected across civilizations, and how the financial psychology of these pioneering women shaped commerce as we know it. To find the earliest women bankers, we need to travel back to ancient Mesopotamia, around 2000 BCE. In the bustling cities of Babylon and Ur, women operated as both merchants and moneylenders, conducting transactions that would be recognizable to any modern banker. These weren't isolated cases or exceptions to the rule. Archaeological records show that women regularly engaged in commercial lending, accepted deposits, and even financed large-scale trading expeditions. What's remarkable is that many of these women operated independently, maintaining their own accounts and legal identity separate from their husbands or fathers. The cuneiform tablets that survived tell us their names, their interest rates, and their business acumen. One particularly notable figure was a woman named Iltani, who lived around 1950 BCE in the city of Sippar. Clay tablets reveal that she ran a sophisticated lending operation, providing capital to merchants and farmers alike. She calculated interest, maintained detailed records, and pursued legal action against defaulters through the Babylonian court system. What's fascinating from a psychological perspective is that Iltani's approach to risk assessment seemed remarkably methodical. She diversified her loans across different sectors, maintained reserves for defaults, and adjusted her interest rates based on the creditworthiness of borrowers. This wasn't instinctive or emotional decision-making, it was calculated financial strategy. The financial psychology of these early women bankers reveals something profound about how they navigated their world. In societies where women's roles were often constrained, the world of commerce offered a unique space of autonomy and power. These women understood something fundamental about money that transcends time. Capital doesn't discriminate based on the gender of its holder. A silver shekel lent by a woman earned the same interest as one lent by a man. This created an unusual meritocracy in ancient economies. Women who demonstrated financial acumen could accumulate wealth and influence that might otherwise be denied to them in political or religious spheres. Moving forward in time, we find women bankers flourishing in medieval Europe, though their stories have been largely erased from popular historical narratives. During the 13th and 14th centuries, women in major trading cities like Paris, Florence, and Bruges operated money-changing businesses and extended credit to merchants, nobility, and even to kings. These women understood the complex web of international trade, fluctuating currency values, and the political risks that could make loans profitable or disastrous. Some operated overtly, while others worked through male proxies when guild regulations or social norms made direct participation difficult. The psychological profile of these medieval women bankers shows a fascinating blend of caution and boldness. Historical records indicate they were often more conservative in their lending practices than their male counterparts, demanding better collateral and maintaining higher capital reserves. Some historians have interpreted this as risk aversion, but a closer examination suggests something more nuanced. These women understood that their position was more precarious. A male banker who lost money might be seen as unlucky or temporarily unwise, but a female banker who failed could confirm prevailing prejudices about women's unsuitability for finance. This awareness created a different risk calculus, not timidity, but a more sophisticated understanding of reputational risk and the asymmetric consequences of failure. In Renaissance Italy, we find perhaps the most remarkable example of women's banking prowess. While the Medici family is celebrated for revolutionizing European banking, less known is that several women within extended banking families managed substantial financial operations. These women navigated the intricate world of papal banking, currency arbitrage, and letters of credit with skill that rivaled their male relatives. They understood that in the world of high finance, information was as valuable as gold, and they cultivated networks of correspondence across Europe who kept them informed of political developments, harvest yields, and merchant movements. The financial psychology of these Renaissance bankers reveals a sophisticated emotional intelligence. They recognized that banking was fundamentally about relationships and trust. Money flows to those who inspire confidence, and these women understood how to project reliability and discretion. They mastered the delicate art of being assertive enough to collect debts while maintaining the social relationships that generated future business. This required reading people with precision, understanding motivations beyond stated reasons, and maintaining composure during negotiations where showing emotion could be exploited as weakness. Across the Atlantic, indigenous women in pre-Columbian societies also operated sophisticated financial systems. Among the Aztecs, women controlled markets and extended credit for commercial ventures. They understood concepts of interest, collateral, and default long before European contact. In some African societies, women's savings clubs and lending circles predated formal banking institutions by centuries. These systems were built on different principles than European banking, emphasizing collective rather than individual benefit and trust networks rather than legal contracts. But they performed similar financial intermediation functions. What's particularly interesting from a psychological standpoint is how these diverse women across cultures independently developed similar financial intuitions. They understood that lending requires assessing not just material wealth, but character. They recognized that diversification reduces risk. They knew that relationships and reputation were assets as valuable as silver or gold. And they grasped that information asymmetry, knowing something others don't, could be converted into profit. These weren't lessons taught in universities or written in treatises. They were hard-won insights gained through practical experience. The gradual exclusion of women from banking over subsequent centuries reveals as much about financial psychology as their initial inclusion. As banking became more formalized and institutionalized during the 17th and 18th centuries, it also became more explicitly male-dominated. Women who had operated freely as moneylenders and merchants found themselves barred from banks, stock exchanges, and commercial partnerships. This wasn't because women had proven incompetent at finance, quite the opposite. The professionalization of banking coincided with its transformation into a source of significant social and political power. And that power was jealously guarded by men who created formal barriers that hadn't existed in earlier, less structured commercial systems. The financial psychology of these excluded women adapted in interesting ways. Unable to participate openly in formal banking, many operated through informal networks, managing family fortunes behind the scenes, or engaging in what we might now call shadow banking. They developed expertise in areas men considered beneath them, managing household accounts, small-scale lending, and savings clubs that nevertheless involved sophisticated financial planning and risk management. Some wealthy women became silent partners in ventures, providing capital while male relatives or associates provided the public face. This created a peculiar split in financial identity. Women who were competent and confident in their actual financial dealings, but who had to perform deference and ignorance in public discourse about money. The legacy of these first women bankers extends far beyond their individual accomplishments. They demonstrated that financial acumen isn't gendered, that risk assessment and capital allocation are learned skills rather than innate traits tied to sex. Their financial psychology, characterized by careful relationship management, sophisticated risk assessment, and strategic use of information, established patterns that would influence commercial practice for generations. When modern research shows that women investors often outperform men by taking fewer unnecessary risks and maintaining longer-term perspectives, we're seeing echoes of strategies these early women bankers employed centuries ago, not because of some essential female nature, but because their constrained position required more thoughtful approaches to financial decision-making. Understanding this history matters for more than academic reasons. It challenges narratives about women's natural relationship with money and finance. It reminds us that women's absence from financial leadership in later centuries was a constructed phenomenon, not a natural order. And it suggests that diverse perspectives in financial decision-making, including those shaped by different experiences of power and risk, may actually strengthen financial systems rather than weaken them. The first women bankers weren't remarkable because they succeeded despite being women. They were remarkable because they helped invent banking itself, and their financial psychology, forged in the complex intersection of commerce, gender, and power, contributed insights that enriched the foundations of modern finance. If you find the video helpful, hit that like button and subscribe to the channel.